In this video, guys, we're going to look at why do current affairs impact the stock market. Hey traders, warm welcome to you. All right, so why do current affairs impact the stock market? This is a great question, right? Because we see this all the time. Okay, something happens in the world, some news, and the stock market responds to it. So quite sensibly, the question is, well, why does that happen? And it's a great question, and I love questions like this because a lot of people just go, well, you should know this kind of stuff. But in reality, this understanding this kind of seemingly simple stuff, supply and demand, influence in the market, what's influenced other people's decisions, is often the key to having a good trading career. Honestly, guys, there are people who don't know the answer to these questions like this, or haven't even thought about it, and they're trying to make a trading strategy. You think, well, if you don't know how other people are influenced and what they're doing, then it's very, very difficult for you to work out who's going to trade. So not to kind of digress slightly, there's stuff on this, guys. I got into real deep dive into kind of price action, supply and demand. I'll stick a link in this comment section below on that, or in the description below. But the point is that for you to make money on a trade, let's say it's a long trade, someone else has to buy after you, right? That's that simple. For you to go make money on a short side, someone has to sell after you, and there has to be a continuation of a more aggressive buying, paying a higher and higher price for your asset to increase in value, and vice versa for short. So why do current affairs impact the stock market? Is a great question, because you're thinking in terms of, well, what's causing, what is the sort of middle part that says trade war with China and panic in stocks? Why is that causing this? Okay, so that's an extreme example, but we'll use that one. The idea of the reason behind this is that this news comes out, the majority of people with large money at stake in the market, institutional funds, hedge funds, mutual funds, etc., they're the ones that arguably move the market the most, right? You and I don't move the market with our relatively small accounts, 50 grand, 100 grand, 200 grand, 10 grand, whatever it may be. Doesn't really do anything, okay? Even if we have it on a massive scale, there is some impact if everyone on a massive scale is doing it, but it's the bigger guys who are shifting tens, hundreds, millions, if not billions in the market. Now, they are thinking many years ahead, generally speaking, and I'm being very generalistic and broad here, they're investing for multiple earnings cycles ahead. They're not thinking about what's happening now. They don't really care what's happening now. They're thinking about what's the impact on my portfolio next year, the year after, 5 years on, even maybe 1 year is maybe too short. These guys are thinking way more ahead because they don't want to be in and out all the time. They want to be positioned as early as possible on a move that ultimately matures. So when they see some sort of current affairs coming in, some sort of news, then it makes them think. And if you can imagine, hypothetically, they're there, board meeting, the managers are saying, listen, we don't like this news that's coming out of China. We think that it could impact these sectors. And there will be analysts and stuff that will present this to the managers, and they'll say, listen, this could be the impact to this sector. If this doesn't go as planned, this could be the impact. This could potentially be the impact to the portfolio. This could potentially be the impact then to our bottom line as a company. And so they will then make the decision and say, well, okay, even though this is not a certainty, we've got some ambiguity here now. We've got some extra data which could affect the return we get on the investments we've got. And so they may well decide to lighten up. They might say, okay, well, let's reduce the holding by 15% across the board, and let's allocate that to bonds, or let's allocate that to something else. And this is how money flows around the different assets. But their decision-making process is based on the current affairs. Now, okay, it could be very, very simple, like, oh, this is catastrophic, in which case is when you see, massive pull downs in stocks because this has been repriced to zero. But when there's some ambiguity like current affairs, then people are making a decision, and then they are putting their money based on how they think the impact of that will be. Now, there'll be some people who will think nothing's going to happen and won't do anything. There'll be some on the other end of the scale who think it's catastrophic and pull all their money out. And there'll be some in the middle that do something or other. But that impacts the price of the market or individual stocks, and ultimately the market, because they are the constituents in the indices because of that decision-making process. So new information comes out, guys will then sit down, okay, I'm simplifying this a bit, but can you imagine, impactful news, decision is made to allocate more capital to the market or less capital to the market, and it's their perception of what's happening. Now, that's one side of it. The other is the inflow and outflow to these funds. Money flows in, money flows out. The same kind of feeling with whoever is investing in these funds will also impact how these funds invest, because if these funds have inflows coming in and they haven't changed their portfolio, they're still going to have to buy stock to match the inflow coming in. Let's just theoretically say they've got 100 million in, they've got another 10 million coming in, they have to increase their portfolio size by 10%, so they have to buy everything they've got, another 10% of that, so which is causing buying pressure. If you don't have those inflows, or if you have outflows, regardless of whether they think the stock's going to go up or down, they're still going to have to take money out of the market to pay back investors. So even investor sentiment, investors may say, you know what, we don't want to invest in, let's use Brexit as an example. We're concerned about Brexit and Britain, so we don't want to invest as international investors until that's sorted out at the end of March. And so that may cause a stall in inflows into funds, which causes a stall in buying in FTSE 100, FTSE 250, FTSE 350 stocks, which then may cause a little bit of a stagnation. That stagnation then people may see that stagnation as weakness and start to pull money out. So you can see how a seemingly benign piece of news, potentially not, but seemingly nothing, don't know what's going on, can cause a cascade of effects of, okay, people aren't going to put money into these funds. These funds may well then go into a little bit of protection mode on various things. They may well now are not buying the market. People see the underlying market not being bought and then become even more cautious. And it's almost like a self-fulfilling prophecy. And it's the same on the bull side as well. Great news, more inflows coming in, sees the market going up. So current affairs basically will determine, or they will impact people's decision-making process, and that is how they're making decisions based on, especially if they're macro investors, or even if it's a current affairs based on some sort of stock, which is why earnings impact stocks so much, because it's people's thought process on, actually, this is very relevant for my time frame. I think that the next 5 years is going to be a great stock, but this earnings has really kind of thrown a spanner in the works here. It doesn't look so great, so I'm going to take my position off, or I'm going to reduce my position. So the constant flow of news, the constant flow of current affairs impacts the stock market because of people's perception of how that's going to impact the valuation of their portfolio in many years' times ahead. And that's why we see, often news which is not that important yet impacting the market, because people are kind of trying to get ahead and trying to be cautious and trying to protect their own assets, protect their own capital. And so we'd sometimes see some pullbacks, or often we see potential good news and a lot of people getting super aggressive, like we saw with years back when Trump said he was going to invest in infrastructure. Bang, everyone thought that was fantastic, and all the infrastructure stocks and steel stocks went crazy. It kind of petered out a bit because it's taking longer than expected. But that's why, because the news is there and people are making decisions based on what they think is going to impact the valuation of the company they're invested in. Take care, guys. Bye-bye.